Goodyear Tire and Rubber Company, ticker symbol GT. I've been eyeing this one recently for a swing. You know, a good company recognizing that tires as it is will never not be needed on a car, unless, of course, this is the new normal. Otherwise, the company, at its most basic form of service, makes sense to me. The business model is there and they make money, right? Surely. Let's look at a couple fundamental things. PE ratio is low, 5.6, relative to the US market, 15.8. This is good because typically companies with a highly valued PE ratio gets dumped on, unless you're Tesla. But generally, a high PE ratio could suggest a company's stock is potentially overvalued. So GT potentially could be undervalued based on PE alone. They are back to profitable after a tumultuous COVID pandemic. Clearly a profitable company in the past. Again, going back to their business model, unless this happens, they'll continue to make money. But things can't all be good, right? There's always something. There has been a significant sell from the inside. That could mean that the insider sees an overvaluation of the stock's price, or potentially is just shedding the position for capital. Who really knows? But we know that it's the CEO, Richard Kramer, who sold 100,000 shares recently back in December 2021. Important to note that he sold at a sick price of 22 a share, which now seems to be miles away from the current price. The stock has been diluted in the past year by about 20%. Dilution occurs when new shares are introduced, resulting in a decrease of shareholders' equity positions. Think about a delicious, nutritious, flavorful pot of soup. If I pour copious amounts of water in it to dilute it, a bowl of that diluted soup is not going to be as flavorful, or in this case, valuable, as the initial bowl before dilution. Typically, dilution reduces EPS, or earnings per share, which would also affect the PE ratio as well. So that's something I want to keep in mind next earnings report, April 29. Anyways, forget the fundy, unfun fundamentals. Let's peek at the real fun stuff. Technical analysis. Price took a fat dump after its most recent earnings, negative 27% in a day after earnings reported. I have a large demand zone marked up. It makes sense to buy here, especially with such a quick, steep drop into demand because of the invasion news on February 24th. I was inspecting the 2024s with the potential of this demand zone cracking and going lower, but I stuck to a cheaper 2023. I was attempting to get filled at a certain price, but I feared I'd miss out, which honestly isn't healthy, but this is a swing with a leap, so a couple dollars doesn't really hurt, right? In the middle of demand, I'll be considering adding another contract. Depending on the market's conditions, I may want another piece of this pie. If you made it this far, feel free to leave me feedback, like, comment, subscribe.